our perspective was probably closer to the VCs, which would be, wow, what a great turn of events in terms of the business model you're underwriting to all of a sudden have this sticky recurring revenue. And of course, this should generate better, more consistent returns at the fund level, right, for LPs. And so I think if we weren't having this conversation, I don't know that I would have appreciated that nuance, because going back to incentives can look really different for different participants in this entire ecosystem.
Hi, this is Matt Pauker with Wendy Lee. We're co-founders at Ivy Invest, and welcome to this week's episode of the Investment Office. Every week we cover the latest in capital markets, alternatives, and retail investing. This week we're going to talk about incentives and how incentives between investors can sometimes be aligned and misaligned. This topic came to me after reading a really interesting post from Will Quist, who's a general partner at Slow Ventures. We'll include a link to the post in the episode description. But I thought it was a really interesting overview of how the rise of SaaS software, subscription SaaS software, had actually misaligned incentives in some interesting ways between founders and VCs. It was kind of an interesting take that I had never heard before.
Well, it's, I'm sure, something that really resonated with you, having been a founder, and the rise of SaaS and subscription models really being more recent versus when you started your first company. Right? So I'm sure you had a visceral reaction to seeing that article.
I did. I almost felt vindicated. So I started my first company back in 2002, Voltage Security. It was an enterprise cybersecurity enterprise software company. And back when we started, like, the way that you sold software was like kind of how you sold anything. You would sell a piece of software and people would buy it. And then often they would pay you some 15 to 20% of the upfront cost. They'd pay you on an annual basis. To give them updates and be able to call you and provide support, et cetera. And then, it was probably about 4 or 5 years in when Salesforce was kind of the first to introduce this idea of, well, maybe you don't buy the thing, but instead you do this kind of subscription model where you pay a little bit, a lot less, but you pay it, every year or every month.
Wait, so I want to step back for a second here, because Matt, you said you felt very vindicated. What did you mean by that?
Well, so we had spent years building up a healthy enterprise software business that was based on selling these perpetual licenses with this kind of more traditional structure. And when Salesforce came on the scene and started having a lot of success, all of a sudden we started getting a lot of pushback from investors and potential investors around, well, like, why are you guys doing it the old way? Why aren't you doing this new SaaS model? It's so nice because the revenues are smoother, it's more predictable, et cetera. And we actually thought hard about, should we try to switch our model up? And we ultimately came to the conclusion that it didn't make sense for us for a bunch of reasons, but a big piece of it was that you got these big upfront checks, right? Like, people would come in and they'd buy the software and you got $1 million in. And that was great, because then that $1 million could go to hiring more engineers, hiring more support folks, whatever it was that you needed to go kind of build out the business. And this is actually this is the point that Will makes in this piece, is that the perpetual model served startups well because it gave them the capital that they needed to continue to build their businesses. Whereas if we had shifted to a SaaS model, yes, maybe the revenue might have become more predictable quarter over quarter, but we wouldn't have had the cash we needed to go actually build the business.
That's so interesting. Have you ever yourself reflected on your experience founding Voltage and how the amount of funding you needed to start the company and how you fundraised compared to what the SaaS software subscription model looks like today, and what that fundraising need would have been if you were to be in that sort of an environment?
Yeah, I mean, looking back, right, we raised about, call it roughly $40 million for that business over 4 rounds, which today, $40 million, like, that's a Series A for a lot of these enterprise software companies, right? And frankly, it was much more expensive to build a business back then than it is now, just in terms of, back then, if you wanted to have mail, you had to go buy servers and install Microsoft Exchange. It was really expensive, right? There was no Gmail that you paid $8 a month for. So, in some sense, the business was actually much more capital intensive, but we were, I think, able to raise less capital in total. And, we started that business in 2002. I think the last round of funding that we raised was maybe in 2007, 2008. And we were able to then cash flow the business until we sold it in 2015. I suspect, hindsight is 2020, but I suspect that if we had adopted a subscription model, we probably would have had to go raise substantially more over time. And that is ownership in the company. Back to Will's point, that would have just accrued to the venture investors. And so this was kind of I think the incentive misalignment point that he was making, that subscription models really benefited venture capital investors because they got to own more of the company.
I think that's something that I'm not sure I would have appreciated that nuance had you not spelled it out so specifically, because as a LP in venture funds, where you are seeing the underwriting for these subscription models where the revenue is recurring, it is predictable, it has this really nice, consistent feature to it. Our perspective was probably closer to the VCs, which would be, wow, what a great turn of events in terms of the business model you're underwriting to all of a sudden have this sticky recurring revenue. And of course, this should generate better, more consistent returns at the fund level, right, for LPs. And so I think if we weren't having this conversation, I don't know that I would have appreciated that nuance, because going back to incentives can look really different for different participants in this entire ecosystem.
Yeah, I mean, for a founder, obviously the incentive is build a big business and hopefully own as much of it as you can. I think for a venture investor, now having also sat on the venture investor side of things for a time, right? You want great outcomes, but you also, of course, want ownership. But I think also the other incentive that is quite misaligned is, I think there's often an incentive for a venture investor, for a GP, to want to deploy more and more capital because they get paid management fees on that capital, right? And so not only are they getting more ownership in these companies because they're more capital intensive, but they can grow their fund sizes, and that 2% management fee starts to get more and more meaningful.
Well, that's definitely one of those where LPs are very sensitive to that part of the incentive structure, right? I think because you're expecting your venture investors to have a specific discipline around how they invest, where these are outcomes that are going to be outlier outcomes, and you're looking for big return outcomes, I think there is this sensitivity with LPs for large venture funds who've gotten larger, who continue to generate a lot of their income across the fund just from management fees versus the ability to generate returns from that incentive structure, right? At some point when you have a massive fund that is charging 2% management fees, in some cases perhaps even higher, that generates a lot of steady income for the partners at that firm. And then it goes back to the question of what's driving decision-making behavior. Because if a GP is able to collect enough just from management fees, that you have to wonder at what point does the incentive and the amount that can be generated from the carry begin to exceed or be multiples of what can be generated from the management fee side, right? Because then it becomes very much to your point, the incentives is the incentive to be an asset gatherer and generate a lot of consistent, predictable fees for that GP, or is that GP incentivized to generate most of their returns and capital and wealth from the carry, which is on performance and the performance of the underlying investments. And so that balance, when it gets thrown off, even a sort of 50-50 even balance, is not great, because again, going back to, we talked about in some ways management fees are like subscription fees. They're consistent, they are predictable, they really depend on the size of the fund. Whereas carry is very dependent, obviously, on that GP's ability to make good investments and generate outsized returns. And so, again, going back to, at some point, when a fund is so large and there's enough coming in just from the management fee, you have to wonder, just given that the idea for LPs investing in venture is to be able to generate outsized returns, if the incentive isn't necessarily there because the manager is generating ample wealth just from the management fee, you start to wonder about the types of risks they're taking, their willingness to put out enough risk on the venture side to be able to generate the outsized returns you might expect from venture investments.
Right. I mean, I feel like that's got to be, to your point, like particularly a problem in venture where you look at the return dispersion of venture relative to other asset classes, and it's huge, right? Like top decile venture can generate amazing returns. But I think historically it's required those venture investors to actually take some real risk and not perhaps look more like private equity firms that are just playing for, doubles and triples.
And that's the perfectly good investment model, right? Like private equity, when LPs are underwriting private equity buyout strategies, they have an expectation for returns that is closer to a 2x net on the fund. And so that's a perfectly acceptable return for that strategy. That's really what folks are underwriting to, because again, the range of outcomes is more banded, and so you're expecting to underwrite to a more predictable return, and predictable is relative here, but the idea is with private equity buyouts, you're really expecting a lower return versus venture because it is, again, more of a bounded range of returns. Typically, if you even just look at distributions of how buyout funds have performed over time, the dispersion in venture, of course, is significantly wider, right? And so there you are looking for funds who can generate outsized returns because the venture risk and the underwriting in venture, and here really speaking more about early stage venture, the risk that's taken is obviously significantly higher, leading to, even within a single venture fund, broader dispersion of returns across the investments. You expect some zeros, you expect some singles and doubles, and then you, of course, expect the ones that can return the fund plus, right? And so there's just this huge spectrum of potential outcomes in venture investments themselves, because startups are obviously higher risk than predictable cash flow generating private equity companies. And so when it comes to what you want to see as a total fund return from a venture fund, there's an expectation that because you're taking on, again, a higher level of risk, that the returns have to be higher, right? So you want to be able to see as an LP a 3x net and in a reasonable time frame, because if you're generating me a 3x net over 20 years, well, I could have the opportunity cost of investing that somewhere else is pretty high. But going back to that concept of what does it take to incentivize a GP to pursue those types of returns and pursue that type of underwriting and the risk taking to be able to generate those types of returns, there's an outstanding question around the right size for different venture strategies, because there is, for certain venture strategies, and particularly on the earlier stage side, where I think at least the fund sizes do need to be a little bit smaller, so that again the GP's own returns come predominantly from their carry as opposed to their management fees. And of course, there are a subset of very large established venture firms that are running larger funds and larger pools of capital, and they may be investing in a slightly different type of strategy than simply early stage, right? They may be really looking to be able to double and triple down on their winners, and where the returns can still be compelling, but there's a very, very, very narrow subset of venture GPs that can run both a large fund and deliver successful outsized outcomes.
I think another interesting incentive dynamic that we've seen a lot more recently in venture, and I imagine elsewhere, is the rise of co-invests, where you'll have a financing round that comes together, and the venture capital firm, rather than taking all of that capital that they have access to down from their permanent fund base, will actually take some piece of their allocation and syndicate it out, go to their LPs and say, hey, would you like to co-invest alongside of us into this deal? And sometimes that co-invest might be done with reduced management fee, no management fee, maybe a lower carry. But I think that can introduce sometimes some interesting incentive dynamics in terms of, why is the fund choosing not to take down the whole piece from within their kind of permanent vehicle, and maybe that's just a size issue. But I'm curious, as an LP, how you think about that.
Yeah, I think that's one of those where sometimes it's really obvious that it's a size issue and the deal is larger, and in order to participate, I think more in terms of private equity buyout, where when an LP is offered a co-invest into an investment, it often is a consequence of something as simple as the investment is a little bit larger than the standard bite size for that fund. And of course, then it does raise questions around, is this the right type of deal for this fund? Does it still fit square into the strategy and wheelhouse? an expertise of this fund manager, and it just happens to be the size a little bit larger than usual. You do, of course, always worry about strategy drift, and certainly pursuing an investment that is orders of magnitude larger can be indicative of that if they are doing something that's outside, again, of their sweet spot. But typically, I think for an LP, it's getting to your question around, is this being syndicated out because the GP is taking down an investment that's a little bit larger than usual, or is it simply this is an investment where they don't feel the highest amount of conviction in it, and so you worry that perhaps they are syndicating out some of the risk to an investment that they may not have the highest conviction in? I think these days, because co-investments have become such a common both request from LPs and common carrot from GPs to offer to their LPs, that I think folks have really come to see co-investments as more of a partnership. And I think some of the questions that might historically have been more prevalent around where incentives were or were not aligned have been, it's really shifted because co-investments are just so much more prevalent now. And I think there's a subset of LPs who that's almost a requirement for when they're investing in a GP, is oftentimes they will explicitly say, are you able to offer co-invest? Because co-invest, certainly on the private equity buyout side, one of the things that it's utilized for is really blending down fees, because it's often offered at no fee, no carry for the LPs. And so again, going back to, it's a carrot from GPs to LPs, and for LPs, it is viewed as a way to really blend down their own fees, and ideally it's a partnership between the LP and the GP. And I'm really speaking mostly to private equity buyout, where co-investments have just become a very prevalent part of the market. And I do think it is not as common, from what I have seen, not as common for GPs to syndicate out their investments directly to LPs on the venture side. I think it's happening with higher frequency, because I think perhaps LPs are translating their experiences from private equity buyout to venture. But I don't know that it's quite as common or as widely used. I don't know. Do you have a take on it? Like, do you think that there's misalignment there?
Where I see the risks and the red flags in venture specifically, I think, and potential misalignment, is one of the common terms that a lot of particularly early stage venture firms will negotiate in their financings are pro rata rights, right? They'll say, hey, we're going to go buy 15% of this company in this financing round, and we want the right in all future rounds to be able to buy more shares such that we can maintain that 15% stake. And so, you lead the Series A round, you buy 15%, Series B comes around, you have the opportunity to buy more, Series C comes around, maybe the opportunity to buy more. And I think the risk there and the red flag that I've seen is that often as those rounds get further along and those allocations represent large dollar amounts, you'll see that venture investors will syndicate those out, and sometimes they are charging some kind of fee or carry. And I think that's the risk, because then the question becomes, well, is the venture investor syndicating this part of their allocation out just because they don't have the capacity to do it? Or are they syndicating it out because they're not actually that convinced about this new financing round, but they might as well syndicate it out because they get paid on it, and let the LP hold the bag if it doesn't go very well. And so that, I think, is where I see the risk of the co-invests in venture.
I think that's probably fair. I think that's one of those things where it is very specific to the dynamics, to your point, in venture, and to your point around pro rata rights and retaining that optionality at the VC level. And I think for LPs, it really depends, right? I think LPs oftentimes, when I think about how co-investment programs are run across a spectrum of LPs, there's a subset that really treats co-investment programs in a programmatic way. And I think that actually is one of the wiser ways to approach co-investing. If you as an LP are approaching your co-investments in this programmatic way, then it may be worthwhile right? To have a slightly different lens in thinking about how you do your venture co-investments, right? Because perhaps that programmatic approach differs given the way that venture pro rata works, and the perhaps easier incentive on the private equity side, where it's really, you've got one decision point when you're buying the company, right? It's not, do you continue to keep funding the company? And so those are repeated decision points, I suppose. I would think, as an LP, again, if the GP is not participating in the pro rata and for whatever reason is getting syndicated out to LPs, I mean, that's such an obvious red flag that I can't imagine that's necessarily one where there's any gray area.
And I don't think it's necessarily a binary thing. But, the VC has $20 million of allocation in this round, and, are they choosing to take 5 of it, or are they choosing to take 15 of it? And I think that's the gray area. And also because I think that there is very frequently a dynamic that the venture investor wants to maintain those ongoing pro rata rights and make sure that in the next round they can continue to buy more. And so there's an incentive to take the full allocation so that you have the full allocation the next time.
To maintain the optionality.
And so, you might, as a venture investor, be willing to underwrite a deal that you're not quite as excited about because you value that optionality. And I think that's where some of the risk lies. Well, that was, I think, a fun foray into the topic of incentives. Thanks for joining us this week on the Investment Office. We'll see you next week.